Okay, we're ready. This is our 27th episode in the TradePod with Sunil Mangwani. How are you doing, Sunil?
Good, all good here, Alan. Good to be over here. Nice of you to call me and let me
Of
talk about.
course, of course.
Yeah,
Actually, we,
yeah,
we tried several times, but it's
yeah,
finally the day.
yeah. Finally, the D-Day. So,
Cool. So introduce yourself to the audience. Tell about your story. How did you begin trading? What are you doing in your day to day? Who are you, Sunil? What's your story?
okay. Uh, I've been trading the currency markets, primarily the currency markets. Now it's been 23 years now, so it's a very long time. Started with currencies, still stick to currencies all the time, but also diverted more. We do equities, we do commodities, also gone into crypto big time now. The simple basis being technical analysis on the charts works for any instrument which has sufficient volatility. So technical analysis works. But let me start with my background and why Forex very
Of
specifically.
course.
I earlier, before I came into this world of trading, I had proper business set up here in India. I'm a resident of India, a construction business, good business, ongoing business, everything was fine. Somehow I'm not very happy with it because even as a builder, your architect gives you the plans, somebody else is building it for you. There's no need for me to use my brains over there. I just do what's being told to do. Due to some personal reasons, I had to shift to some home-based works. And somewhere I came across trading the financial markets, and just took a kind of a fascination for it and started with currencies, very surprisingly, because for those of you not aware, in India today, currency trading in the international markets is still not allowed. So an Indian resident cannot trade in the international currency markets. We can trade in the Indian rupee, but not in the international market. So it was very surprising that I got into this. Somehow I found a lot of fascination into it because there was a little bit of technical analysis involved, a little bit of mathematics. My background is that I have graduated in physics and maths with a diploma in finance. So there was this kind of gel somewhere along the way.
And then when you finished the bachelor degree, right, you did also a master's and also a PhD.
No, not really a PhD. I just did a master's in finance after that, after my maths.
And then you went to work in a construction company.
That has been a family business.
Oh, okay.
I wanted to become a pilot, to be honest. So I wanted, I still fly by passion, but it was family business, went into it. It was going fine. There's nothing wrong in it. But somewhere I was not very happy with it. Came across trading and technical analysis coming to Forex very specifically right from the beginning, what I saw compared to any other markets today. You trade equities, maybe even commodities, there is some fundamental factors involved in it. With equities, you look at a share, company performance, and then you would come to technical analysis. So it takes a kind of a secondary stage. In currencies, in Forex, technical analysis takes the first place. We are speculators, short-term traders, not intraday traders, which I would like to talk about a little more later. But
So just
fundamentals
a
in
question:
currency,
technical analysis is more important than fundamental in forex.
in Forex, absolutely. Absolutely. It works more, and there is a reason for it. For traders, retail traders, I mean, we are retail traders, we are individual, we call ourselves retail traders, we trade for speculation. So, long term fundamentals like interest rates of the US dollar or the Eurozone, inflations, employments will affect you if you are trading or holding on to a currency for 6 months, definitely.
Mhm.
But if our trade, like I'm a swing trader, my trades last from maybe about 2 days to a week, maybe one day sometimes. These long term fundamentals, I'm not saying they don't matter, but they come secondary to technical analysis. Yes, we do keep a watch on news, which affects news release, which affects the movements. But because currencies are traded primarily by the banks and the institutes. So there's something which I would like to delve on a little later. Technical analysis, what you see on the charts is what you get. So what you see on the charts is almost 80% of the movement which you can guess, fundamentals becoming 20%. And since it's charts, and I had a fascination for Mathematics, geometry very specifically. Believe me, I would take my son's geometry books and study parallelograms to look at it. Price action is not random. Believe me, it's not random. People say price action is random, but there's no randomity in it. There is a geometry, there is a movement behind the madness. Anyway, so went into it, got fascinated.
But just if you think about it, well, the movement is based upon feelings, our
Exactly.
feelings. So
Exactly.
in
Exactly.
somewhat, it is random. I mean,
Well, to put a kind of a counter argument on it, as you rightly said, movement is based on feelings, demand and supply, right? You
yeah,
buy something, somebody has to sell it to you. Now, a simple fact about Forex, which not many people are aware of, we are aware that it is the largest financial market with a daily turnover of what? Almost 7 trillion as of today. But what most people are not aware of is that almost 70% of this is done by the banks, the big institutes and the banks. You have these Euromoney surveys coming out every year. There is a group of 10 banks which controls about 70% of this entire turnover. Now, if they are controlling 70% out of their entire 70% of trading, more than 60% is done for speculative purposes. Banks are the exchanges, they are the market makers in Forex. I want to exchange currency, I want to travel, I'll go to a bank, to a travel agent, to a bank. Companies, they want to export, import, hedge currencies, they'll go to a bank. But with the banks, 60% of the trading is done for speculative purpose. That brings me to supply and demand. They will place orders beforehand, before the market reaching somewhere. There are specific places where they'll place orders and they have the money. If Bank of America places $1 billion of buy at a certain level, simple fact is, what do you need to fill that buy? They need sellers. So they will slowly start driving price, creating sellers to that. So they create the demand and supply, which does not make it random. That's the point.
yeah.
Um, it is, and trust me, see, in my years of experience, let me start from the beginning. I learned technical analysis. I thought I was very good at using indicators. I studied each and every indicator, tweaked every indicator with a mathematics background. Demo trading was fine. The minute I started with a live account, I blew it up. It took me almost 1.5 years. I blew up account after account after account, and it was
How many
frustrating.
years?
1.5 years.
1.5.
Years to become reasonably successful. And when I say reasonably successful, when you're making money consistently, it's not that you make money 1 month and then you lose your entire capital the next month. If you're making small amounts consistently, that means you're reasonable. Like every other trader, it looks all hunky dory, you know your technical analysis, but then I realized what I was doing wrong, which is what I do today. Through all the indicators out of the window, use only price action because that's where the demand and supply is. Use a lot of Fibonacci. Surprisingly, Fibonacci does work. Now, if you ask me why, I don't think I'll be able to tell you why it works in the market, but it's a kind of a herd mentality because these levels are known to everybody. People tend to place orders around these levels, and the banks know it. You know it, I know it, the banks know it. So they will also take advantage of that situation. Most important of all, I realized that it's a risk management at the end of the day, which keeps your account growing. If your risk management policy in place and your technical analysis is correct, you rely only on supply and demand and price action, you have a much better chance. I used to use a lot of indicators. I just threw everything out. And in the process, I started, I won't say teaching, traders would come to me that, okay, this is what, and so I've become successful using these. So I started conducting some sessions initially. I put up my first office in London almost no, 14 years back, 13, 14 years back, because we couldn't trade from India. I used to conduct my sessions over there. In the course of my sessions, I'm a speaker at various Forex expos. I'm a regular speaker. A lot of Forex expos worldwide,
Hmm.
right from US, Spain, Moscow, London, Singapore. I'm a regular speaker. At one of the money shows in London, we had an open session about risk management. There's a very interesting story behind this. It was a full room of about 150 people free. Session was good, a lot of question answers. At the end of the day, end of the session, an elderly gentleman comes up to me. He says, I like your concept, and would you do a session for my traders about risk management? I said, sure. Which company are you representing? And he said, I am the head trader for this particular bank. I'm not going to name that bank. And I was like, are you kidding? You guys trade billions of dollars a day, and you want me to come there? He said, no, our systems are set. There's nothing. Our systems are set from generations. We know what to trade. My traders need some discipline, and I want to put these points of risk management. I said, okay, I have a condition. I need to spend 2 days on the floor with them to see how they're trading so I can implement these. Trust me, Alan, that changed my entire outlook of trading because now I was on the other side and I could see how the banks trap retail traders.
Like they do not care. They
They
just
do not.
speculate. They
That's
have
it.
the information, they have the power, they have the money.
They have the money and they do have the information. They have an advantage. You and me are dealing with brokers. The brokers have got they get their data from the market makers, which is the bank. So the banks have access to the brokers' order books. They know exactly where big orders are. And they will place orders only to stop out the retail traders. And this, again, even Fibonacci, they use a lot of Fibonacci. So this is why I say it's not really random. Forex is a beast by itself. Today, when I teach, the first thing I talk to everybody, you must understand the nature of this market, that when you are trading, somebody's there on the opposite side of a trade. In Forex, there's a bank who's on the other side of you. That bank has got deep pockets. He's got huge resources, which puts you at a disadvantage right in the beginning. And unless you're not careful, you are just a small fish in the shark infested waters, is what I call it. So this is how the market is. And I can say I've been reasonably over the number of years, taught so many traders. I have personal mentorship programs. They've been doing reasonably well. Not all of them, of course, but so understanding the market and understanding what makes the market tick, knowing the background, coming from a place where I have lost a lot of money, know where new traders make a mistake, that makes a lot of difference.
So you said you threw all the indicators now, and you started Fibonacci patterns and so on and so forth.
Yeah.
Why Fibonacci? Why exactly that?
Well, one, you can call it an indicator. It's a tool, but it's a simple indicator where if price retraces in a trend, it tends to find support or resistance, as the case may be, at certain levels. And even the banks use these levels to determine. Let's say you're in an uptrend, price is going up, it retraces. They would place their orders at certain Fibonacci levels combined with something else also. But Fibonacci, yes. Again, why does it really work so effective? Why the 61.8 is quite effective? I really won't have an answer for that, but it's because everybody uses it. People realize the importance. So traders tend to place orders around these levels, which is why it makes it effective. And unlike indicators, which are lagging, all indicators are lagging. I mean, if you look at the calculation of an indicator, it's based on price. So price moves first, which makes the indicator move. So it's never going to give you a leading edge. But Fibonacci, if you're looking at expected levels of support or resistance, you can calculate them before price reaches that level, that expected level. So it makes it kind of a leading indicator. That's right.
Guys, so you're predicting rather than looking at
Right.
the past data.
Right.
Cool. So let's talk about the Fibonacci itself. Why it's so special? Why do you think it's so special? Why do you think it's occurs in nature, like the golden ratio?
Yeah.
It's relating to maths, but it's relating to trading as well. The
It
question is, why do you think it's so?
Well, I have a theory on that. Fibonacci occurs in nature. Fibonacci occurs in the human body. That is simple, humorous facts about the human body. If you take the entire, measure your height, and you measure your height from your head to your belly button, any human being, and you divide the two, it's always 0.618. Always. If you measure the
Really?
length of your arm from tip of shoulder to your fingertip, and you measure from the arm to your elbow and you divide the two, it's always 0.618 in any human being. All right. So there are a lot of Fibonacci ratios in the human body. There is lots more that I can go about. But my take is because markets are controlled by humans, we have Fibonacci ratios, we work on Fibonacci ratios, so we tend to follow Fibonacci. That's just my humorous take on it. If you ask me why, honestly, I wouldn't know. But like I said, it's been going on for a long time. Institutes follow it, banks follow it, which is why you have a lot of traders tending to follow. And it does work. It does.
Then the question is, who started first? The retail traders or the banks?
True. That we'll have to just get into the research and find out. Yeah.
Definitely. So you emphasize risk management and mindset as key components of successful trading.
Right.
Now, can you explain how these aspects become central to your approach over the years?
Yeah. So I have this concept which I've developed over the number of years, which I personally follow. I call it the 3 M's. The 3 M's being very specifically money, mind, and method in that order. So if I take these 3 M's, let's say on a scale of 1 is to 10 and I distribute it, the money, which is your risk management, will take up 5 parts out of 10. Your mind factor will take up 3 parts of 10. And the mind factor is nothing but discipline and patience. That's only 2 facts that I put it down. And the method is the technical analysis, indicators, Fibonacci's, whatever you're using, takes up only 2 parts out of 10. Now, what happens is, unless you do not incorporate risk management and your mind factor in your trading process, you have a negligible chance of surviving in this market. And most traders are not aware of this concept. And I wouldn't put them at fault, because if you do a Google search today and look for trading systems, 90% of them out there talk about indicators and charts. Nobody talks about risk management. Nobody talks about your mind factor. So for a new trader who comes in, he or she thinks that this is the way to go. And that's how I started. I had no realization and I used to keep losing money. But the simple fact is, I often tell my students, the people who come to me, risk management is the most important thing. I mean, I joke about this. If you trade with the toss of a coin, heads I go long and tails I go short, and you follow your rules of risk management, you will still probably make money. But I could give you the best trading system in the world. And if you don't follow your risk management, there's no chance that you can make money. It's that important. And then the second importance comes your mind factor. It's human emotions, they control the market. If a currency or any financial instrument, let's say it's going up, somebody's buying, somebody is selling. So perspectives of two people are very different on the same instrument. That's just human emotions. And the most
Yeah.
important factor, I call it, is discipline and patience. Discipline to have a trade plan, which becomes important. I don't get into a trade because of knee-jerk reactions. I have my setups. I see this setup and I will get into a trade only when this happens. On an average, I'm more of a swing trader. I trade on the 4 hour chart, maybe the 1 hour. I don't go below that. This, again, small term trading, short term trading in forex does not really work very well. I might have, and by history, I get about 1 or 2 trades a week is what I get into. But this discipline has to be there, that unless the setup is there, I am not going to get into the trade. And then the patience to wait for the market to give you that setup. It's very difficult. When you're a trader and you are full time into this, you're just sitting over there waiting for the market to give you your setup. You're at the seat of your pants and you want to do something. This is where most traders tend to lose money, that there's no plan, but because I'm not doing anything and the market is going without me, I must get into a trade. So these are very important. And it's crucial for a trader. It's just as simple as that.
And how do I manage risk management? So, for example, if I decide to move on to different system of risk management because
Yeah.
I believe it's better, should I? Because I do need to test it. I do need to validate the risk management system that I want to transfer to.
Right.
But I don't know if I'm gonna lose money or not. But probably I'm gonna lose money and a lot.
Right.
But I don't know if in the long term it's profitable. What should I do in this situation?
Well, this brings me to another part of your mind factor, which is important. That when you start off as a trader, you don't expect to become successful in 3 months or maybe 4 months or 1 month. I mean, I always give an analogy of a doctor or a pilot who's trained and he has to undergo a lot of training to become really proficient at what he does, and then he starts his practice. It's a similar thing. People come with false expectations into the market that I'll do a course, I'll understand something, and within 3 months, I'll become a successful trader. Now, coming back to this, how do I ensure that I win? How do I follow the rules of risk management? Personally, I am not in favor of backtesting. Backtesting and all is good. I mean, I have a system, I can put my rules of risk management, I can backtest it for 10 years of data and I can get the results. But it's more of human emotions which don't come in your backtesting. For example, I follow a system or a technique called the divergence. It's a pretty common technique. Everybody knows what a divergence is. So you can spot a divergence on a chart. If I do a backtesting, this backtesting is going to identify those divergence setups which have worked. What about the divergence setups which have not worked? And which have not worked, you cannot see them on your backtesting, right? It does not show. So the only way to succeed is to do forward testing, which means after you are proficient at your trading, you have a trade plan, you have the rules of risk management in place, you need to demo trade or trade with a very small amount of money for at least 6 months to 8 months. And this has been my standard to it. If at the end of 6 months, you can make small amounts consistently, you're good to go. And this is a time factor which comes in because the time factor relates to your mind factor, which is the experience. Unfortunately, experience is such a thing that it gives you a lesson first and then you understand what it is. So you need to lose money to really understand what works, what does not work. And coming to another point is how many trades do you really need to, go over to see that you're successful? Traders don't give themselves a chance. They'll take a basket of 10 trades, 15 trades, 20 trades, maybe 25 trades. And if they have a larger number of losses, they'll switch a system, they'll go somewhere else. You need to have a basket of a minimum 100 trades is what my thumb rule is. If out of 100 trades, you have 50 correct trades or 50% win-loss ratio, believe me, you're an excellent trader. But people don't have the patience to wait for that. So which is your time factor which comes in, your experience which comes in, and how effective is my system? You need to test it over a number of times, forward test it, small amounts of money, demo account, whatever you're comfortable with. But this is crucial. People don't give themselves the chance to prove that the system works or does not work.
Sure. So I should have a system and simply to follow. To follow a system for about 6 to 8 weeks, right? A month.
At least minimum. I would say 6 months. 6 months.
6 months.
6 months. And believe me, the more you take trades based on one or maybe two systems, I'm not saying just decide on one system. You may have two different approaches. One, depending on the market, one is a trend system, one is a system which works in a range. You have to be flexible about that. You can't stick to one. The markets keep changing all the time. But have two systems, follow it to the T, have a trade plan. This builds in your discipline. That I am following this regardless of whether this trade is going to be a winner or a loser. But this is what I'm supposed to do. It's only those traders I have seen who eventually go on to become successful. Most traders don't. And the statistics we know, retail traders, almost 80 to 85% of retail traders lose money. And I can honestly tell you these are the reasons. No risk management, no mindset, no forward testing, no giving the system chance to prove itself. You switch from system to system. You don't have a trade plan. That's all. It's not that they are not good traders. These factors are more important.
Yeah, for sure. So let's go back to Fibonacci and divergence. Like, can you show like in live how it's how it works?
The Fibonacci's?
Yeah.
Yeah. Okay.
It is
What I
fascinating.
can do, yeah, I can share my screen. There is one particular setup that I'm following right now. So which is on the USD CAD. I'm just going to show it. I just put it on my demo account, the ADJPY. Here you go. Right. So, okay. Now this is, if I just maybe zoom out a little. Now this is,
Is it multi-charts?
these are the MetaTrader charts. So there is this particular, this is on the 1 hour. And I am waiting for a certain price to go up to a certain level. But what is more important is I do have the annotation tool here. Let me just give it. Yeah, you see this, we had this move up and we had this retracement. And this retracement stopped exactly at the 61.8 right there. This was exactly at the 61.8. Now, you can ask yourself 10 questions, why this particular level, what it is. Again, it does come down to a lot of factors. The banks have probably kept their orders over there. And it's just very simple that when price starts going down over here, there are already buy orders placed over here at the 61.8 level by the institutes, by the banks, call it professional traders, whatever it is. Now, the simple fact is to fulfill their buy orders, they need sellers. So they will start selling aggressively, attracting more sellers into the market. And when price reaches here, some retail traders will make some money till here, be very happy that, oh, yes, I can still go down, I've made money. But it runs into this stack of buy orders placed by the professionals, and you have a price bounce from there. That's it. So you can ask yourself, why 61.8? Well, I really wouldn't know why 61.8, but you can see the effectiveness of why it works. Now, there's something called divergence over here. So this was a trade that we had taken. I do have a kind of a room where I share with the traders who have taken courses with me. We had taken this trade based on a concept called divergence when price made a higher high and your indicator makes a lower high. So this was a classical divergence. We have refined it. We know exactly where to enter, what is going to be the target. And this was our expected target. Let me show you the effectiveness of Fibonacci's. Now, 61.8 is definitely a longer term support level. But as far as your Fibonacci's are concerned, for my divergence, I also have a ratio, which is the 127, which is a projection ratio, 127.2. So if I do a projection of this 127.2, it would, or it did confluence exactly with, just close this one. Okay. So if I take this, so if I take this over here, you can see this where it came down to the 127.2. So this confluenced with, or let me show you this 127.2. Just where's my annotation tool? I just seem to have lost it. Just give me a moment. Oh, there you go. Sorry about that. Right. So this 127.2.
Yeah.
Confluenced with this 61.8. and this becomes a great target. So it's a target zone. And we took a trade precisely from sell from here to here, closed it off right over there, knowing that. And now I'm expecting it, in spite of this movement here, I'm expecting it to go up to another level before I can consider a sell. I am not getting into a sell now. Now that's part of a trade plan. Now these are all harmonic patterns. I kind of specialize in harmonic patterns, which are not complicated, believe me. They are based on Fibonacci ratios, and that's just about it. Just simple Fibonacci ratios. And I'm waiting for price to come up somewhere over here to a certain Fibonacci level. If it does, then I'm looking for a sell down. If it doesn't, if price keeps going down, well, I don't have a trade and I forget about it. So that's my trade plan. And this becomes important, that when I'm looking at a currency, this is what I'm waiting for. If it works out, fair enough. If it doesn't, if it goes without me, okay, it wasn't my plan in any case. But if it does work out, the point is I am prepared with this 100%. I know exactly where to enter. I know exactly where my stop is. I know exactly where my target is. I know how much of risk management I'm going to take in this trade. So I am prepared for it. Now, these factors by itself, when you have a trade plan before you enter a trade, these are the simple facts for success, which most traders do not.
Yeah. So, and what again? What is your condition to enter a trade?
Well, there are different factors to it. We rely a lot on what we call zones also. There are a lot of supply demand zones that we look at. There are levels of Fibonacci's we look at. If I'm looking at an indicator, the only reason when I look at an indicator is when I spot a divergence. That's the only reason. Otherwise, I am not looking at anything. We use a lot of trend lines, which again, as part of my course, I do have a very specific section on how to plot the trend lines correctly. Most people really don't know how to use the trend lines correctly. If used correctly, they can be very, very effective. It's just simple. And so combination of different factors, which is part of the entire course. So when we talk about my entry is going to be here, my target is going to be here, there is a reason. It's based on a Fibonacci level, a zone, a trend line break, which gives us a higher probability of getting into a trade. Now, in spite of that, do we have losing trades? Of course, we have losing trades. There's nothing I can do to control the market. But in all this process, what I'm doing is I am eliminating more than half of my unsure trades because I'm waiting for price to get somewhere. In the process, have I missed out on trades? Yes, there are a lot of times when I'm waiting, price doesn't do what I expect it to do. It's like the market has a way of humbling you, you know. It's like,
Yeah.
say, you're smart, okay, here you go. And I'm going to give you a good kick on the backside. So it does that. You have to be prepared for that. So
Can you give an example? How do retail traders can position themselves to follow the big players, the banks, the institutions? How can I simply see that something is happening on the graph,
okay. Now,
on the
I'm going
chart?
to go, yeah, I'm going to go on the same AUD JPY because this was, now you see these are my harmonic patterns. They're nothing else based on simple Fibonacci's. So the executions, everything else is based entirely on a preparation. Now, when I say that I'm waiting for this level, see, I've marked it over here. I'm still expecting that price can keep going up to this level. There is a strong possibility. There are two reasons. There's an important Fibonacci level there, which is much more effective than the 61.8. Then there are zones, and I can plot this particular zone over here.
But obviously, you are adjusting your decision also on fundamentals, not only on the
A
on
small
the.
part of fundamentals, definitely. When I'm taking a position, let's say that this is a zone that I'm looking at, and I expect that My way of looking at it, that some institutes have got some orders over here, is my way of looking at these zones. Now, if I'm expecting price to still move up over here, then I would look at the calendar and say, okay, today, is there anything on in news release? Let's say the US CPI is going to come out, the inflation reports, which will affect the USD, which will affect the JPY, which will affect this. And that can probably push this guy right up to that level. So that's where my fundamentals come in. I don't trade the news, believe me. I wait for the news to release, wait for market to make it move, its moves, and usually post news price generally tends to move towards a level of support or resistance, fulfilling our trade. That's what our trade plan is usually about.
Got it. And how do you spot anything like any institutional movement?
Well, I can give you a trade secret over here. Believe me, it's a trade secret, and I learned it from the banks. You have supply and demand zones, right? So generally in question, anything which has a support to it. So I would say that this has got a lot of support. This will effectively be a good support zone. Now, support and resistance zones can also be, or they are supply and demand zones. And institutional orders, bank orders are placed at these supply and demand zones. Let's not call them support and resistance. Let's just call them supply and demand. So just to go back to this particular incident, when I was sitting on the floor with these bank traders, even before price came down over here, right, they already had a buy order placed over here. My question was always to them, why here? Why not here? Why not here? Why this particular? And of course, they were cagey about it, saying that it's a system given by banks. But then, when you sit in the pub in the evening, have some beers with them, you come out with some good nuggets. And they have been taught, bank traders, the first thing in technical analysis is how do you identify a good zone where you can place anticipatory orders for speculation, of course, is when you have a zone which has turned from support to resistance. Now, if you look at this, this was resistance, this was support. Now, this is very unconventional wise. People don't usually look at it. But like I told you, it's a trade secret, which is part of my course. But it's always traders should understand this. The bank traders will place these orders. They'll identify this, which has turned resistance to support, and they will place their orders over here. I can rest assured I have 80% probability that there are buy orders over here as and when price comes down. Now, if I'm expecting price to go up over here, maybe it may not. But if it keeps coming down, and you can quote me on this, and we'll come back to this after 1 week if you want, and you check, there will definitely be some reaction because I know there are buy orders. Now, it depends
So
on how many.
eventually it will get to this level and it will go up again.
Well,
If it will
there
go
are
up.
two ways to look at it. If the buy orders are very strong, then yes, it'll go. If the sell orders at that stage are more than the buy orders, what would happen is price would come down over here, have some reaction because of the buy orders, but it can still go down. So that
So
is
it
something
depends.
as
Yeah.
retail traders, we don't know. And this is part of our course that we need to be prepared. It's not that because there's a zone, I am going to place a buy order right now. No, there is a possibility it can still keep going down, but at least I'm forewarned knowing that this is a level that I need to look at. For me, that's more important. Can I wait 5 days for this trade? Of course I can. I'm not going to do anything to it. Wait for it. When it comes here, I have a probable trade. Right?
So if it
Yeah.
goes to there, what do? You place a trade?
We
You place
no
you entering a trade?
we would expect price to go up over here because this, if you look at this blue pattern, this is a classical harmonic pattern. And this is what we call as a Gartley. Again, it's not my pattern. It's been over a number of years, but when a Gartley completes over here, the possibility of a bounce from here is very high. And this is the power of Fibonacci's. Your harmonic patterns are nothing but based on certain levels that if price stopped at 61.8 over here, and it stopped at this particular fib level that I'm looking at over here, then the third time, if it does stop over here, the probability of this trade is huge. That's the advantage of harmonic. So I don't know when this is going to happen, but I keep a watch on this. That is important. Yeah.
Got it. It's fascinating. I mean, it is maths. I mean, it is fundamentals as well, but most of it's just patterns.
It is.
More patterns, Fibonacci patterns.
Yep. So anyway, if I'm going to share more,
yeah, just a question. What other information do you look at? Like you have harmonic patterns, Fibonacci patterns. What are the most useful ones?
Not really. See, divergence is, if you look at chart patterns, I really don't follow too much of chart patterns. If we talk about candlestick patterns, yes, we do look at candlestick patterns, but candlestick patterns have a disadvantage in forex. Candlestick patterns work very well in equities and futures where they have centralized exchanges. So you have a daily trading, you have gaps over there. If you read candlestick patterns, if you read Steve Nissen candlestick patterns, all of these patterns are quite effective, but almost 70% of the patterns are based on gaps and they work well on equities. Forex does not have gaps. It's a continuous market. So it eliminates almost 70% of your candlestick patterns, which will not work because we don't have gaps. But yes, if you have at a particular Fibonacci level, you come across a hammer or a good double, what we call as a railway track system, they are effective. So yes, candlestick patterns we keep a watch on. Chart patterns, again, not so much. If you look at divergence now, if you saw this with divergence, what happens? In a bullish divergence, there has been support and price breaches that support and then goes up. So if I'm looking at double bottoms, I would probably get stopped out. The nature or essence of a divergence is a bank is going to take out the stops of the traders who are trading double bottoms. That's the whole idea of a divergence. So chart patterns, again, not very effective. Head and shoulders, I have my own take on it. A harmonic pattern creates a head and shoulders by itself. So it works, but I would rely on Fibonacci's. What are the factors? Currencies have an advantage. We look at correlations. It gives us good clues. Look at correlations with other markets, correlations with other currencies. It kind of gives you an odds and answer that the possibility of this trade is working or does not work. And also certain timings. The fundamentals come in over here. The US Open creates volatility. The London Open creates certain volatility. So these are the factors which you should be aware of.
Got it. Fascinating.
Yep.
Do you have any tips? How do you stay resilient through losses from your own experience?
This, I put it down to experience. It's not easy, again, as they say, that you take a loss on a trade, forget about it, move on to the next trade. I've learned this the hard way. I still have that. It's human nature. You make a loss in a trade, you have this nature, you want to recover your loss. You would probably go and take a revenge trade. You would probably go, throw your rules of risk management outside the window saying that I'm going to risk a little more because I need to recover my loss. This comes from experience, Alan. And this is what I say. See, technical analysis as a skill you learn when you trade. Risk management or human emotions as a skill takes time for a trader because it gets time to use to it. Today, I don't really feel so much if I have a loss, Fair enough, forget it. Let me move on to the next trade. To reach that stage, it's taken me a lot of years, and this is where the traders need that experience. You've taken a loss, fair enough. Let's move to the next trade. Because when I take a trade, once I have entered the trade, you see, the market takes over. I am not in control of the trade. The market is in control of the trade. There's nothing I can do about it except manage my trade. So my trade plan is I have all my odds in my favor. I take the trade. And it's happened. Like just last week, we had a trade which was going fantastically well. There was some news release on the inflation, which drove it the other way around. There was nothing you can do about it. So a nice profitable trade went into a loss. It hit the stop loss. So when I enter a trade, it's with the intention, I don't care whether it's going to be a loss or a win. I follow my rules. I take a loss, fair enough. Let me move on to the next trade. Now, this is how you should avoid or get into that zone, which is not easy, which is the most difficult part for any trader to do.
Yeah, definitely.
Yeah. And this is where your risk management also comes into play. See, there are two golden rules of risk management that we follow. Again, you are making me spill all my secrets over here today, and I'm going to give you it. But see, these are very simple facts, and I tell this to every trader. Every trader knows this, but they just don't follow it. There are just two golden rules of risk management. If you follow these two golden rules, believe me, you are in the top 10% of the traders just naturally. But people don't tend to follow it, even though it's absolutely common. Everybody knows it. The first is never risk more than 1% of your capital on a single trade. Maybe 2% for retail traders. I would even go to maybe 2.5%, which is fine. But for new traders, 1%. Traders are not happy with this because they say if I'm risking so small amount, I'm going to make a smaller profit. How the hell do I make my profits? How is my account going to grow? But it does, believe me. So this is one. Second is your risk to reward ratio, which is the most important of your risk management rules. You must have a minimum risk to reward ratio of 1:2. In fact, 1:3 is what I keep for forex. And this is where your trade plan comes in, because before you enter the trade, like I showed you on the chart, that this is the place where I expect price to go. If it does, this is my entry, this is my target, this is my stop. So my risk to reward ratios are in front of me before I enter the trade. Forex has a big advantage because it trends, it tends to trend. So if you catch a trade, it's not only 1:3. I've had trades where we get 1:10, 1:15. And these are trade management rules which we implement as part of our trading process. But the simple thumb rule of your risk management is if I'm maintaining 1:3 for every trade, which in Forex, which I tend to do, the simple fact is that one winning trade takes care of three losing trades from me. So if I have one winning trade, I can afford to have three losing trades and my capital will still be at break even. Now, this is a huge advantage. This is just simple mathematics. Like I said, if you just follow these two rules, believe me, it makes so much of a difference. But people, again, human nature comes. So you take a trade, you're not sure where your profit is, where your loss is, or when you are in a trade, price starts going against you, you panic, you get out of the trade, you come out with a risk to reward ratio of 0.5. And then when you're trading prices going towards your stop loss, you tend to move your stop loss, right? Or I think it's going to stop. Let me take it a little more. And then it still keeps going down in a buy trade, and then you take it a little more. Oh, there's a good support zone down there, I'm sure it's not going to break that, and you take it a little more down, and before you know it, price starts chasing your stop loss, and your risk of 1 goes to your risk of 3, whereas your profit has only been 0.5. So your mathematics is turned inverted and you cannot make money. It's just simple mathematics. So,
Yeah, that's why algos is there.
it does. It's just human
I mean, in
emotions.
some
It's
way.
nothing. That's the way the market works.
Yeah.
Yeah.
Sunil,
Yeah.
thank you. Thank you for coming. Thank you for
No.
sharing this valuable information. Really, thank you.
It's a pleasure. It's a pleasure. It's always been my endeavor has always been to put the traders on the right path. That's it. I mean, you start with the right process, and then whether you make it or not, but you stand a much better chance. Now, I've written a book. I'm an author of a book which is
I
available
will
on
attach it.
Amazon.
I'll attach the episode for sure.
Yeah. And it just says this. It says it's 7 secrets of professional traders, and this is exactly what it talks about. There is no trading systems over there. There is no technical analysis. It's an intention that a trader should start on the right path, get on the right path, and then you have a better chance. So always happy to talk to traders. Always happy. Yeah.
Okay. Thank you. Thank you. Bye
My
bye.
pleasure. My pleasure, Alan. Thank you so much. All right. Bye.